Okay, thanks for coming, everyone. Just wanted to thank Colton from Baird for coming, and Robert and Alan, sorry, for coming to tell us a little bit about ways that we can invest and save and all that good stuff. So thanks, Colton. Yeah, appreciate you.
Okay. Well, thanks again, everybody, for coming. Got a riveting presentation of Social Security and Medicare and 1031s. But again, my name's Colton Brookshire. This is my partner and father, Alan Brookshire. We work with Baird. We're off Charlotte Street, really close to here. But been working with individuals, families, business owners here in Asheville for a couple generations now. So really close to Asheville, is near and dear to our hearts. But I'm going to kind of hand things off to Alan and let him kind of kick off the presentation. He's really the leader of our group and has much more knowledge than I do. So without further ado, I'll let Alan take over.
So we've got a very specific slide deck today, and I promise I'm not going to go through all of them. We're going to talk a little bit about retirement planning, talk a little bit about Social Security and Medicare, a little bit about 1031, but this is very informal. So any questions that you have, just please, ask. We're happy to chat about anything that we can. So I'm just going to jump into this. Retirement planning obviously is a huge topic. I think as we all watch, what's happening, with our federal government over the past few years, the confidence in depending on Social Security to take care of us in retirement is, just getting less and less and less. And so I think for all of our clients, we certainly urge, I think Social Security is going to be there. I think for folks who are closer to retirement, I think Social Security is probably going to be exactly what they've said it's going to be. But, for younger folks, I'm just not sure that I would, count on it. Certainly not count on it exclusively. So we're going to talk about, some options that you have as business owners to save for yourselves. Basically, I think everybody in here is more or less self-employed, whether you're, on your own or you're like a 1099 employee. I'm going to hit just a handful of options. Obviously, the whole benefit of doing some sort of retirement plan is tax-deferred growth. So it doesn't really matter whether you're putting money into some sort of a Roth structure where you're putting it in after tax, or if you're putting it in pre-tax. The benefit of the plan is that tax-deferred growth that you get over time. And I'm not going to, belabor this, but this slide simply just shows if you're earning 11% on average per year, which is probably, that if you invest in the S&P 500 or the U.S. stock market over time, 11% is about the average rate of return. You can see that over 25 years, you're basically doubling your money. By not paying taxes every year on, the dividends on the growth and whatnot. So tax deferred growth is why you would want to consider setting up some sort of retirement plan for yourselves. It's pretty crazy that if you just put in $250 a month for 25 years, that you can have $1 million, almost $1.5 million bucks. But you can. The old saying says, obviously the best day to plant a tree was yesterday, but the next best day is today. So if you feel like you're behind the 8 ball, don't let that stop you. One of the things that our team would be happy to do, if anyone, a lot of folks have been saving, they just don't really know, are they on track or not? Do I have enough, or am I saving enough? And we'd be happy to get with you offline and help, make that a little bit more clear for you. Benefits of a retirement plan. I'm going to skip through a lot of this stuff. Basically, when it comes to the types of retirement plans that real estate agents can set up for themselves, there's 3 general categories: IRA-based plans, defined contribution plans, and defined benefit plans. And I'm going to hit the highlights of all these. The IRA-based plans are the easiest and the cheapest and the simplest. often they're going to give you smaller, like maximum contribution amounts. But they're cheap and they're easy, and there's no like required IRS filings. And I'll get into the weeds on that. The defined contribution plan, basically just think 401k. I mean, that's really what that is. And you don't have to work for a company in order to have a 401k. You can actually have your own 401k as a self-employed person. And then for those of you that are just, selling all kinds of real estate and have tons of income to shelter, we're going to talk about something called a defined benefit plan, otherwise known as a pension plan, that gives you massive capabilities in terms of making annual contributions. So, in the very simplest and most common IRA-based plan that we see for folks in your line of work is a SEP. A SEP is very simple. You can do it 1 year. You don't have to do it the next. You get the benefit of the doubt. You can make a SEP contribution for 2025 all the way up until you file your 25 tax return. So if you can make a SEP contribution and take the deduction this year and not have to pay for it until sometime in 2026. If you extend your return in 2026, you can actually make your SEP contribution October of next year and still get the deduction for this year. I think the biggest thing to keep in mind when it comes to a SEP is you're going to be limited. That contribution is limited to 25% of, the net income from your work. If I don't know if you are operating as a sole proprietor or an LLC, or if you set up a corporation, basically whatever that bottom line is, if you make $100,000 in 2025, you can deduct 25% of it into a SEP, up to a max of $72,000.
It'll be the lesser of the two, right? So if you make enough money that 25% of your income is 72, you can put the 72, right? Mm-hmm. But if you make 100,000, in his example, 25% of that's not 72,000. You can only go up to that 25%. So it'll be the lesser.
So for folks, maybe you've not had a super profitable year. If 25% of your profit isn't a big number, that's where some of these other plans are going to probably be more attractive. But SEP, simplest way to do it, 25%. You can do it 1 year, not the next. Very, very easy. No IRS filings, no tax returns, no administration. The next IRA-based plan is called a simple. A simple, you're going to note on here, your maximum contribution in a simple is $17,000. That's a lot less than $72,000. But what's interesting about a simple is if your business made $17,000 and you want to contribute 100% of that profit to a simple, you can. So there's no percentage cap on the simple plan. That's what makes this attractive. For businesses that don't, where the 25% of your profit isn't going to be enough of a contribution, a simple might be the way to go. And I think that you can elect to match it in addition to the 17, getting your total contribution up, closer to 20 grand. But these are the two easiest ones to do. There's no, you can do it, like I said, 1 year, not the next. You do not get the benefit of the doubt. Like with the SEP, when I said you can actually make the contribution on into the next year, that's not really the case with the simple. If you're going to do a simple plan, you have to have that plan established by October of the year that you want, the contribution. So it's too late to do a simple for 2025, but you could set one up for 2026 if you wanted to do that. I'm going to switch gears and get into The defined contribution plan, again, this should be just sort of synonymous with 401k. It also includes something called a profit sharing plan. The benefit of a 401k is that you can put in more money than you can put in a SEP. So in a 401k, you can defer up to $24,500. Again, you have that same, there's no percentage cap on how much of your income you put in. So you can put up to 100%, but you're capped at 24.5 unless you combine that 401k with a profit sharing plan. And that's often what we see, especially for self-employed people. So basically with a 401k plan, you can get up to that same $72,000 maximum contribution by sort of combining the 401k with something called a profit sharing plan. And I'm not going to get like into the weeds on any of this stuff. But like if a light bulb goes off and this is something that you think you might want to do a deeper dive on, we're happy to chat offline about that. A 401k is probably the most common plan that we see. It's not the cheapest because if you have a 401k plan, you have to do some annual filing with the IRS. You have to file something called a 5500 form. If you have anybody that works for you, it gets a little bit more complicated. So you will have some administrative costs on the 401k that you're not going to have in the earlier examples that we've talked about, but it's not prohibited. I mean, if you're in a position where you can save, $10,000, $20,000, $30,000 a year, the cost is not going to be, a real prohibitive roadblock, in my opinion.
One quick thing to note, depending on where you are in age, in different 401k plan steps, there's something called catching up. So if you're over the age of 50, you can make additional contributions, or there's now like a catching up, which if you're basically over the age of 60, you get that add additional money. So, and also 2026 numbers are kind of changing. So this year, and this example says 24,500. This year's actually 23.5. That's a 24 number. But again, just keep in mind that based on where you are, from an age standpoint, you might skew up or down on some. Well, actually, it's only skew up on some of these numbers.
Any questions so far?
I just want to clarify. So a lot older employee, as you mentioned, people are self-employed contractors. What impact does that have? The ability on that contract?
Yeah, I would. If you're an independent contractor, if you're a real estate agent, self-employed, you are both the employer and the employee. So for example, in a SEP plan, it's a 100%, employer contribution, but for the purpose of this conversation, that's one and the same. Unless you have salaried people that work for you in your business, and we would want to footnote that. But if you're self-employed, you are both the employer and the employee. And in these plans where you see contributions from both, you're allowed to do both. So essentially, you're going to be able to do the maximum employee deferral and the employer match if you're a self-employed person.
So it's matching yourself. Okay.
Defined benefit plans. You don't see that many of these anymore. My dad, worked for one company, his entire life. He retired with like 45 years and he got a pension, he never put any money in it. The company paid for it. Very unusual to see those in today's world. But you, as a business owner, have the ability to do a pension plan for yourself. And in the previous examples, when I was talking about defined contribution, so the IRS defines like what percentage you can contribute each year. With a defined benefit plan, the amount that you can put in is calculated based on the outcome that we're seeking. So I'll use a very simple example. Let's say you're 50 years old and you want to retire by 65. and you want to have $50,000 a year of income from your retirement plan. Well, if you haven't started saving yet and you're trying to get enough money to spend, to kick off 50 grand a year, you're going to have to save a lot. But fortunately, under the tax rules, under a defined benefit plan, you can literally pre-tax put $200,000 a year away. I mean, these are complicated. It requires an actuary. There's a lot of administration. But if you have a really profitable practice and you have the ability, if you have the profits and you would like to contribute 6 figures a year and deduct every dime of it into a retirement plan, you can do that. It's called the defined benefit plan. It's often referred to as a cash balance plan. You may have heard that term before. This is not what the IRS does not want you to do is like, let's say, you have just, you get this incredible listing and you sell this, incredible property and 2025 is going to be an anomaly. You're going to make a ton of money this year. The IRS doesn't want you to do this plan just for 1 year. So the expectation is you're going to set your contribution at a level that you feel like you can make it at least for 2 or 3 years. If you made a huge contribution to a defined benefit plan for 1 year and then the next year you did nothing, it's very likely that the IRS is going to say no and disallow that contribution. But we have a few clients that are in your line of work that do these for themselves. The ability to defer tax is incredible. But if it's the right thing for you, talk to us about it. We do a lot of these. But it is a bit complicated. So, any questions on like retirement plans and savings before we just totally switch gears? The thing about our firm, we have no real axe to grind. At Baird, we don't really have proprietary products. So with our clients, we don't care if you might want to have your money with Fidelity or Vanguard or, don't let that be a deterrent to talking to us because our team can still help you, regardless of, we're not trying to sell you like our mousetrap. I'll leave it at that. Social Security and Medicare. The only reason I'm bringing this up, in the real estate profession, we see a lot of folks doing this sort of as a second career. Maybe you've retired from something else. Maybe you're doing this later in life. Maybe not. Maybe you're just preparing for retirement. But we get a lot of questions these days about Social Security and Medicare, and so I just wanted to hit a couple of highlights here. We do a lot of planning around this, and I'm happy to answer any questions. Obviously, Social Security is a kind of a bit of a controversial topic right now, but it is a huge part of Americans' retirement income. In order to get Social Security, you have to have 40 quarters of contributions. Basically, that's 10 years of work. If you've worked and you've paid in for 10 years, you're going to get a benefit. If you haven't yet, what I would encourage everybody to do is go home, log into ssa.gov, go through the verification process and get a printout of what your projected benefit is. It's very easy to do. It's available online. I think that's something that we should all do. Just to look and make sure there aren't any errors in your benefit. You can start taking Social Security as early as 62. Everybody in this room, your normal retirement age is probably going to be 66 and 9 months, based on your birthday. But you can take it as early as 62. A lot of folks don't take it early. If you take it early, there's a pretty significant reduction in your benefit. It's basically a 30% reduction in your benefit for the rest of your life. And one of the most common exercises that we have is, somebody's 62, 63, they're thinking about turning on their Social Security. And so the question becomes, how much is that going to hurt me? How long would I have to live to break even if I don't take it early? Those are all things that we'd be happy to talk with you about and help you with. But you can take it as early as 62. A lot of folks actually defer their benefit to age 70. If your normal retirement age is 66 and you decide not to turn it on, your benefit's going to actually grow at 8% per year until you turn it on. Until 70. At 70, there is no reason to defer any longer because it stops going up. So at 70, you definitely want to turn that on. I would say as a rule of thumb, for clients that elect not to take it early, but to take it at full retirement age, the break-even point is about 10 years. So it is, as long as you're pretty confident that you're going to live 10 years after 66, you will have collected more money from Social Security by age 76 than had you started your benefit at 62 and taken it over that entire period of time. Now, we're happy to run custom calculations on all of that, but generally speaking, assuming that it stays solvent and they pay what they're going to pay, 10 years is basically the deal. Any questions on that piece of it? I think there's some info in here about spousal benefits. Let me just talk about that really quickly. If you're married, if you've been married for 10 years, I should say, or if you were married for 10 years, you may qualify, or your spouse may qualify for something called a spousal benefit. So my wife, I can't say she doesn't work. She works. She just doesn't work for a paycheck. If her Social Security benefit were based on her earnings record, it would be zero. She gets nothing. But because we've been married, she will get a benefit no less than half of mine. So when I turn my Social Security benefit on, if I'm getting $2,000 a month, they're going to send her $1,000 a month just for the benefit of being a spouse. So there's a lot of questions around spousal benefits. If my wife had worked, what they would do is they would compare her spousal benefit based on my earnings record to her own earnings, and she would get the higher of the two. Obviously, if you're married and one spouse dies, Social Security is going to give whoever had the highest benefit, the survivor is going to continue with that higher benefit. So if husband's getting $2,000 a month and the wife's getting $1,000, husband dies, the wife now inherits the husband's benefit, and it steps up. Ex-wives, ex-husbands. If you were married to, a real jerk for at least 10 years, but they made a lot of money, maybe, you can still collect Social Security off of their benefit. Doesn't even matter if they've remarried. So often that comes into play. We can chat about that. I think when it comes to claiming Social Security and when to turn it on, that's just a really subjective conversation that you need to talk to somebody about. If you have your own advisor, have that conversation. Life expectancy, health, there are just lots of factors that kind of figure into, like, when does it make sense to do this or not do this? Again, you're welcome to check with us. This is a big one, especially for those of you that are thinking about turning on Social Security and still working part-time. I'll summarize this by saying, if you've achieved your full retirement age, which for most people in this room is going to be 66 and change, you can make as much money as you want to make after your full retirement age, and it will not impact your Social Security at all. Let me say that again. If you're if you're past full retirement age, the government doesn't care how much money you make. They're not going to try to offset your Social Security benefit. However, if you're not yet at your full retirement age, if you're 62 and you want to turn it on, maybe you're afraid that Social Security is going to fail and you want to get it while you can. Just be aware, and this is an index number, but basically, for every dollar you make over 23,400, you're going to lose $1, 50 cents on the dollar. So for every dollar over that earnings limit you earn, you're going to lose 50 cents on the dollar on your Social Security. So for example, if you're 62 and you turn on Social Security and you end up earning, $35,000 of earnings that year, that extra, $12,000 over this limit that you earned, they're going to take $6,000 away from your Social Security. So rarely does it make any sense at all to take Social Security early if you're planning on making more than that limit. Does that make sense? If you're going to turn Social Security on in the year that you reach your full retirement age and you're still working, just talk to somebody, because that there's a complicated calculation there that you've got to be really careful about how much you earn in the year that you turn on your benefit if you're turning it on to coincide with your full retirement age. That's probably it on Social Security. Back in 1982, Congress has a great way of sneaking all this garbage into bills that they pass that they don't really talk about. This was a big one. Social Security used to be tax free. When you got your check, you don't have to pay tax on it. That's no longer the case. So, your Social Security benefit may or may not be taxed. It simply depends on how much money, what your other income is. So, basically, if you're married, and you're making from investment income, earned income, any income, if your income is over $44,000 a year, 85% of your Social Security benefit is going to be taxed. There's another threshold, I think at $32,000, 50% of your Social Security is taxed. If Social Security is your only income, it will be tax free. But just keep in mind, Social Security is not tax free. And again, this is another thing to sort of be aware of in terms of when you begin the benefit and how you structure your income. Even if you get, a lot of folks, we talk about tax-free bonds. Here in North Carolina, municipal bonds, tax-free bonds are very popular investments. They are federally tax-free, but guess what? The government considers that tax-free income toward this number. So they're not really tax-free when it comes to Social Security. Yes.
Is the first show calculated each year, and are you reimbursed on your taxes?
So for the benefit of the recording, the question is the threshold calculated each year, and are you reimbursed? The threshold is calculated each year. Tell me a little bit more about the second part of that question. I'm not following the reimbursement.
Say you're taxed at an 85% 1 year, so your taxes have already been removed. File your tax at the end of the year, and I didn't make that much. Is that going to be reflected on your federal tax returns?
I think the short answer to that is yes. Keep in mind that, when you turn on your Social Security, it's like right now, you all probably send in quarterly estimates. You probably don't. I get a paycheck. I'm a W-2 employee, and so they take taxes out of my paycheck, but you all are probably like prepaying your own taxes. So, when you turn on your Social Security, you're going to fill out a form as to whether or not you want the government to withhold tax from that amount of money. Most people don't. But if in your example, if you're making estimated payments, assuming that your Social Security is going to be taxed, and you end up not hitting that threshold or whatever, you definitely would get that money back. It would just be like, if you overpay your quarterly estimates, you get that money back. And this would be the same. If that answers your question. Oh. All right. Medicare. I'm not going to, get too far in the weeds on this. Basically, Medicare is government provided health insurance if you're 65 or old. A lot of folks think that like Medicare is tied to Social Security. It's really not. If you turn on your Social Security at 62, you don't get Medicare until you're 65. If you wait until 70 to turn on Social Security, you still get Medicare at 65. So Medicare 65 really has nothing to do with Social Security. That's the first point. Medicare comes, Part A, Part B, Part D. Again, if anybody has questions about this, we're happy to meet offline. Part A is simply hospitalization. Part B would be like outpatient care, so like going to see a doctor. Part D, prescription drugs. Basically, Part A, again, I just don't want to spend a lot of time talking about this. This is probably not all that important. I will say that is anybody here on Medicare? If you're on Medicare, IRMA, you may have heard of IRMA. This is another one of those sneaky tax things. Basically, the amount that you pay for the amount you pay in Medicare premiums is indexed to your income, and really that's all IRMA stands for. So, for example, if you're making less than $106,000 individually or jointly $200,000, your premium for Medicare insurance is $185 a month. That's just for everybody in America. That's what they pay. But if your income is higher than that, you can see your premiums go up. So the only reason I bring this up is there's a 2-year look back. So basically, your Medicare premium is going to be based on what your income was 2 years ago. So just think about that as you're getting close to 65 and turning it on. That's a great time to kind of structure your income, or know that, if you're already on Medicare and you have some huge income year, it's probably going to impact, the premiums that you pay. It's just, something to budget for and be aware of. Basically, it's a 2-year look back. Most people, Medicare doesn't pay for every single thing. So what generally happens when you sign up for Medicare, you're going to sign up for some supplemental insurance that really comes in 2 flavors. You can get something called a Medicare supplement policy. And then you can do something called Medicare Advantage. And if anybody's interested in, like the differences on that, we'd be happy to get you some resources. We're not really in the health insurance business. We just advise folks around that topic. But again, I think in the real estate world, there are a lot of folks that are selling real estate full-time or part-time past the age of 65. And so this is all, very relevant info. There is a so basically just be aware that if you're 65 and you don't sign up, maybe you don't want to pay the premium or whatever. When you do eventually sign up, they're going to get you. Yeah. So if you don't sign up for Medicare when you're eligible to, just know that there could be a penalty with that. There are some exceptions. Maybe you're still, this really wouldn't apply for a self-employed person, but maybe you're on your, you have a spouse that you're covered by their insurance from their employer. That would be an exception to this Medicare thing. So there are some ways around it, but just be aware that you probably ought to sign up for Medicare when you're eligible. And so maybe finally something that is relevant to your business, 1031s. So, everybody here probably knows the basics of a 1031 exchange. Let's say you've got a client that has a property that they want to sell and possibly defer the tax on the sale of that transaction by identifying a replacement income property. And so I'm not gonna get too far in the weeds on, I get at least once a week, I have a client tell me, hey, I want to sell my house and 1031 into my new house. That, it has to be investment property. It can't be your residence, right? Now, it can be maybe a former residence. We'll talk about some examples, but basically 1031, client has an investment property, low basis, maybe they depreciate it, they want to sell it, they want to buy something else. You're familiar that you can't just schedule a closing with, Gooseman Rose. You gotta use a qualified intermediary. And I don't even know that, is there one in Asheville? We usually use one out of Greenville. If
Bankers said it's
okay,
actually out. Sir.
Okay, great. Well, we need to get in touch with them. So you've got to use a qualified intermediary to do the closing. As you all know, that starts a clock. You've got 180 days. First 45 days is to identify the replacement property. Then you've got 135 days to actually close on that property. The opportunity that we have found, and this may or may not be of benefit to you, but a lot of times, maybe they can't find a replacement property, or maybe they don't want to have a replacement property. We have a solution where essentially what ultimately is going to happen is you're selling this property for them, and that money is going to go through a 1031 process and ultimately land in a diversified portfolio of real estate that's liquid. So let me just kind of give you the high level details of that. This is used something, it's called a Delaware statutory trust. We work with several companies that offer these DST solutions, but long story short, my client, you sell a warehouse in West Asheville, that money goes to the qualified intermediary. We don't find a traditional replacement property. So we're gonna go down this DST route. So what would happen in this case? We're talking about a company called Ares. It's one of the largest commercial, real estate companies in the world. They would have they have these like all the time. They just rotate. Generally, it's going to be like an industrial property, a warehouse. Sometimes it's a multifamily complex in Atlanta. So the DST is a specific property that's owned by this statutory trust. Your client's money goes in there. It stays in that DST for 2 years. It has to stay there for 2 years. It's illiquid. They can't touch it. They are getting income from it. That whatever that income is getting paid out. But at the end of the 2-year period, there's what we call it an UPREIT transaction. But basically, this bigger portfolio of real estate buys that DST property. Now your client is in this big pool of diversified real estate. They've avoided the tax, and now they're left with something that they can keep forever, and it'll get a stepped up basis when they die. They can sell it all. They can sell part of it. What they can't do, because this is the end of the road when it comes to 1031, you can't 1031 out of it. So this is like the end destination. Maybe they're tired of property management and they just want to collect income.
But still maintain investment in real estate.
Right. Most of the companies that offer these solutions have pretty long-term audited track records, so you can see kind of what the performance has been. One of the really neat aspects of this, have you ever had a client wanting to do a 1031, but they had debt on that property that they're selling? So basically, if you're selling an investment property through a 1031 exchange and that property is financed, that debt generally creates something called boot in that transaction, and that boot becomes a taxable, even though you're 1031ing, most of it, whatever that debt is going to come out as boot and pay tax on it. Ares has developed a way to actually roll the debt into the DST, and they never have to pay tax on the boot. That's getting way in the weeds on that. But we've done a number of these where, we saved hundreds of thousands of dollars of tax by not having to pay boot on the 1031 exchange. I think, this slide deck is available for you guys. If you had any questions about it, again, this is just a simple timeline. You've got, your qualifying property, you sell it, close with the intermediary, money goes into the DST, sits there for 2 years. At the end of that, UPREIT transaction happens. Now we're in this liquid portfolio, and your client has lots of flexibility as to what they do. I'm not going to get into all of these. You guys do this all day, every day. The slides just give some examples of, maybe two people get married and they start renting one of their houses and they fully depreciate that house. Obviously, that's a perfect candidate for a 1031 exchange when they ultimately go to sell that house. Farmers, lots of farms in Western North Carolina that are getting bought by developers. Perfect opportunities for 1031 exchange. Most of those farms have zero basis. They talk about here, medical practices. Very often, medical practices, the real estate is owned separately from the practice. So even if they're selling the practice, there's some opportunities around those buildings to do the 1031 with. We run into this all the time. Three guys form an LLC. They go buy some commercial property together. Then they figure out they don't like each other.
Yeah.
That can be messy. And so this solution allows them to eventually get to a place where they don't have to like each other. They don't, they can do whatever they want to do. Yeah. I won't go through all that. So, yes, ma'am.
Is there something whereby somebody has invested property for whatever time is necessary? Can they move into it for a certain amount of time and then still have that be a 1031 exchange?
Yes, they could. But more importantly, if they could pass the use test, they could probably sell it. What is it? 2 out of the last 5? Yes. And get the, $500,000 cap gain exclusion. We see that a lot. People will kind of move back into a rental property for a couple of years in order to sell it and be able to not pay, to get that $500,000 exclusion. But I mean, I don't want to talk out of school on the, you know, if they've moved back into an investment property for 2 years, do they qualify?
But I absolutely I don't need that there was an investment property that they're gonna, and I know that how they renovated it into it, and they say they're going to do just their exchange. We were got the defense,
Yeah.
but I thought, how can you do that?
Yeah. Make sure we have your I'll get you a very specific answer to that question. I suspect there's also kind of a use test that comes into play there, but I
Reach your board up some.
I mean, I would think that you could, but I don't know.
So is there, so is there, if you do live in the house for 2 years, but because of the appreciation, 500, the 200, if you're $500 and whatever it is, doesn't cover everything, and you want to do a 1031 exchange, is there like a 12-month, I've heard like you want to move out, make an investment property for 12 months, then you can turn it in, then you could actually 1031 it. Is
that sounds reasonable. I don't know specifically that would be the case, but I would think that by moving out of it, it's now an investment property for a year. Yeah, I mean that probably would satisfy. But we can get you a detailed answer. But
that another conversation I was having with somebody, and that's a bit.
Yeah, I mean, I wouldn't imagine,
because if you bought a house here in 2012 and now you're trying to sell it, you may be over capital.
That's right. I will say though, in today's world, paying long-term capital gains tax, I mean, that's the best tax you could possibly pay. But we'll get back to you with an answer. Anything else? I mean, somebody's got to have like a crypto question or an AI question. Well, thank you. Thank you for the opportunity to come out and chat and